Are you struggling to come up with your 20% down payment for a Toronto home purchase because it's taking too long and so much of your money is going to the cost of living? Hi and welcome. I'm Arlene Monzar, a dedicated realtor in the Toronto market with over a decade of experience in the field. In this video, I'll be uncovering those 3 key facts about down payments that will help you strategize more effectively so that you can buy your Toronto home faster. My goal is to help you achieve the home of your dreams because my motto is, a happy home means a happy life. So let's dive into the key facts about down payments when buying a home in Toronto. First things first, what is a down payment? According to the Government of Canada's website, a down payment is the amount of money put towards the purchase of a home. Your lender then deducts the down payment from the purchase price of your home, and the difference between the purchase price of the home and your down payment becomes the amount of your mortgage. In Canada, the minimum down payment requirements are contingent upon the purchase price of the property. It's a common misconception that you're required to make a 20% down payment when buying a home in Toronto. Now, this is only true if you purchase a home that's priced at $1 million or higher. If you buy a home that's under $1 million, even if the purchase price is $1 less at $999,999, and you plan to occupy the home, you're not required to make that 20% down payment. I think that the misconception stems from the fact that if you're purchasing a home with less than a 20% down payment, then you're subject to paying mortgage default insurance. However, given the rapid increase in home prices that the Toronto real estate market has seen over the past decade, it was always prudent for buyers to opt for paying the insurance premium because you couldn't save fast enough and be able to get the home in the location that you could afford. You would simply be priced out of the market in bidding wars and be forced to buy elsewhere. If you have any real estate questions that I can help by answering, please feel free to leave a comment or reach out directly to me. My contact information is in the description below. How much will you need for a down payment? Regardless of whether you're that first-time home buyer or you're purchasing your second home, the minimum down payment in Ontario is 5% on the first $500,000 of the purchase price of the property, and then a second amount of 10% on the remaining balance up to $1 million. When the purchase price of your home is at $1 million or above, then the 20% down payment is required. For example, if you're purchasing a home priced at $800,000, you can calculate your minimum down payment by adding the 2 amounts. Here's how it works. The first amount is 5% on the first $500,000 of that $800,000 purchase price, which is equal to $25,000. The second amount is 10% on the remaining balance of $300,000. $800,000 minus $500,000 is $300,000, and 10% of $300,000 is $30,000. Then you add the $25,000 and the $30,000 to give you a total down payment of $55,000. If you're finding this information to be helpful, I encourage you to show your support by liking this video and by subscribing to my channel, and I thank you for your support. What is mortgage loan insurance? Under the Office of the Superintendent of Financial Institutions, otherwise known as OSFI, their regulations stipulate that you're required to purchase CMHC insurance or private mortgage insurance if your down payment is below 20%. This type of insurance is mandatory and it protects the mortgage lender in the event that you're unable to make your mortgage payments. However, it does not provide any direct protection for you as the borrower. Mortgage loan insurance is sometimes referred to as mortgage default insurance, and in Canada there are 3 default insurance providers: CMHC, Sagan, and Canada Guarantee. In some cases, even if you do have a 20% down payment, your lender may still require you to obtain mortgage loan insurance. This is typically the case if you're self-employed or if you have poor credit history. Your down payment determines the amount of mortgage default insurance you'll pay. The premium you pay for the mortgage loan insurance is calculated as a percent of your mortgage amount, up to 4%. Therefore, as your down payment increases, your premium decreases. As seen in the table here, with a traditional down payment of 5%, which is a 95% loan-to-value ratio, the standard purchase premium is 4%. To give you a simple example, when you purchase a $500,000 home and put a 5% down payment of $25,000 down, you will be charged a premium of 4% on the mortgage amount of $475,000. This $19,000 will be rolled into your mortgage loan. The premium is added to your mortgage amount and it's paid off over the duration of your loan. Insurance premium is financed as part of your mortgage, and unlike closing costs, there isn't a lump sum cash payment at the time of purchasing your home. To watch my video on closing costs, simply click the link above. If you're finding this content to be helpful and would like more information regarding the Toronto real estate market, please feel free to link to my website and download my free 2023 Toronto Real Estate Guide, How to Succeed in Today's Market. The link to my website is in the description below. How to fund your down payment quickly. There are various ways to fund your down payment. Traditional methods include saving a portion from each of your paychecks, selling or borrowing against owned assets like stocks or personal property, seeking financial assistance from immediate family. A more strategic plan is for you to borrow against your RSP in the Home Buyers Plan. Simply click the link above to watch my full video on the Home Buyers Plan. If you have an RSP plan through your work where your contributions are matched by your employer, you need to be putting funds into that plan today, because it's like getting free money for investing in your future. You first need to verify through your work that you're actually allowed to withdraw funds for the HBP first. In this plan, the Government of Canada allows first-time home buyers to withdraw up to $35,000 from their RRSP for a home purchase tax-free. If both you and your employer are contributing funds to your RRSP, you'll reach your savings target that much faster. Starting April 2023, the federal government of Canada is allowing prospective first-time home buyers to save for their first home in a tax-free savings account called the First Home Savings Account. The FSHA is essentially a tax shelter that offers tax deductions on your contributions, and any earnings within the account are tax-free. Notably, when you withdraw funds from the account, you're not required to repay them, unlike the Home Buyers Plan. Existing homeowners, for example, if you're a condo owner looking to purchase a house because you need more space, can use a HELOC, which acts like a revolving line of credit to fund the down payment on a new property. You can tap into the equity of your home by borrowing funds based on its current fair market value. Considering that your home is likely appreciated in value since you've bought it, you can leverage this increased value. Please consult with your lender regarding the new regulations because some borrowers may no longer qualify for a HELOC. If you're looking for strategic real estate advice, whether you're buying or selling in Toronto, regardless if you're that first-time home buyer, whether you're upsizing, downsizing, or relocating to Toronto, please feel free to reach out to me directly and arrange a consultation where we can discuss your unique situation and develop that optimal strategy to get you from where you currently are to where you want to live in Toronto. My contact information is in the description below, and I look forward to hearing from you.